Hi, this is Linda Eedes, and this is an update on the RECM Global Flexible Fund, looking specifically at the second quarter of 2017. So if you look at the fund, it retraced a little bit this quarter after very strong returns over the past year. It was down by 3.5%. That's against a backdrop of the South African equity market, which was also negative. The JSE All-Share Index was down 0.5%, but if you actually strip out Naspers, which makes up 18% of that index, and which was up 10%, then the rest of the domestic equity market was actually down 2.5%. So that gives you a sense of what's actually happening outside of those outliers such as Naspers, which was up in line with a lot of the big global tech giants like Amazon and the likes. The RECM Global Flexible Fund is up 25% since the beginning of 2016. And I think what's notable about that is that this is in the context of a market environment locally and globally, which has continued to go up at the overall level. So often there's this perception that value as a style only outperforms when markets crash or in the very early stages of a bull market. And I think that what sort of the last year and a half has shown is that, you know, when that dislocation just becomes too extreme, you can have value stocks outperforming even in the context of a market which is actually fairly buoyant. And over the last quarter, we pretty much saw a repeat of the first quarter of this year, which is that, you know, there was a lot of positive sentiment towards equities globally, which saw a lot of sort of growth stocks having a little bit of a resurgence in this quarter. But really, if you take it a little bit further back, it's really been the value stocks which have delivered the returns over that time frame. And we believe that will be the case going forward. If you look at valuations and sort of how the businesses that have performed over the sort of last 5 to 7 years are priced, then it gives you a very clear picture that the returns are really going to be muted from this point onwards for those stocks at best, and that, you know, sort of your opportunity to generate inflation-beating returns is going to come from those parts of the market which have been through a very tough market environment where earnings are depressed, and that combination of earnings sort of coming back to something more normal as the cycle progresses and low valuations or attractively priced stocks makes for a much better sort of return profile going forward. So as I mentioned, during the quarter, the portfolio did retrace a bit, and that was largely as a result of the domestic portion of the portfolio. So in the past, we've spoken about how the domestic equity portion has become increasingly focused into a lot of industrial type businesses. Of course, if you think about those types of businesses, the more domestically focused South Africa incorporated stories, that's really where the tough operating conditions have been. That's where earnings have been depressed. That's where a lot of businesses have been through a whole process of restructuring, cost cutting, and making themselves sort of better capitalized. And that is really where the return potential is in the local market. But that is also where there is probably the most uncertainty as well. Those businesses obviously very much linked to South African stories, and obviously of late it's been the Gupta emails, it's been sort of a bit of uncertainty regarding the proposed new mining charter, and a lot of political noise as well, and that's led to a lot of uncertainty in terms of how assets should be priced in the local market. So looking at the composition of the portfolio now as at the end of June, the overall asset exposure is still tilted towards South African assets. We've got roughly a third of the portfolio in global assets, and obviously then 2/3 in a combination of South African equities, bonds, and cash. And again, this reflects the fact that the rand isn't significantly overvalued. There isn't sort of a strong fundamental reason to suggest that the rand will materially depreciate from this point. And I think that's in stark contrast with sentiment out there. With everything that we're sort of hearing, everything we know, all the political noise, there's this very strong feeling that the rand is about to massively depreciate. But in actual fact, if you look at inflation differentials, it's trading close to fair value, which means it's sort of neutral. It's probably a good time to take a strategic allocation to global assets. But if you look at the global portion of the portfolio, the challenge we face is that we prefer to invest almost exclusively in high quality businesses that are trading at attractive prices in the global segment of the portfolio. And if you look at the market environment, it's just not really providing us with that many of those sorts of opportunities. It's providing us with more than we saw 2 years ago in more diversified areas of the market, but not enough to really sort of fill our boots. The overall equity allocation has decreased slightly over the quarter from 73% to 67%, and that's looking at global and local stocks together. And that's largely because of the fact that we've sold down a lot of positions that have rallied strongly, especially on the global side, companies like Mail.ru, which has also participated in the sort of technology rally, such as Naspers has, Rolls-Royce, JD.com, the luxury goods retailer Coach, which benefited from a very strong swing in positive sentiment towards emerging markets. Emerging markets were actually the top performers in terms of the markets globally over the last quarter. Alfa Laval also performed very well, so we sold that down slightly, and ALS as well. We're still quite cautious about increasing exposure to interest-bearing investments such as bonds and property. They're not quite there in terms of the yields that we'd need them to be to justify a larger allocation. And we're generally quite cautious about anything priced off the interest rate curve. So because interest rates have been repressed for quite a long while, there is quite a risk of that unwinding and the impact that that would have on those parts of the market. So if you look at the composition of the fund, it's actually a lot more diversified now than it was 2 years ago. It's actually got a lot of new stocks in that equity portion. So we have more than 20 new holdings compared to June last year. So just over the last year, we've actually introduced 20 completely new investment ideas to the portfolio. That's both locally and globally. And a lot of the stocks have rallied that we had a year ago. So we've sold out a lot of the stocks that we held, and that includes a lot of the resource stocks like Glencore, South 32, Alumina, ArcelorMittal, Merafi, the Russian bank Sberbank, which rallied so strongly, and IT companies which also did very well, such as Microsoft. And we've bought into quite a few stocks locally and globally over the past year as opportunities have opened up. So it's a very fresh value portfolio. It's got a lot of potential. It's nicely balanced. It's got many out-of-index, family-owned, quality businesses, which for one or another reason are attractively priced. And obviously for that reason, we believe that there is a very compelling opportunity set in this portfolio today. What's particularly good is that the portfolio is widened and we're not overly reliant on any one particular investment thesis being proven right within a particular frame of time. And that's really what you want when you've got a value portfolio. Then you have time on your side, you've got a robust portfolio, and that at the overall level is presenting a fairly smooth portfolio of returns rather than a very volatile portfolio of returns being dragged around by any one or two stocks. So turning to the top 10 stocks, you can see you've still got a very nice diversified mix there. You've got your investment holding vehicles, HCI, RECM and Caliber, which we still believe are very undervalued and sit on very good assets. You've got MTN, the telecoms company, which is still struggling through a tough time. Implats and Amplats, the platinum producers, which is probably the one area of the resources market where we still think there is compelling value. They haven't rallied as much as the other stocks I've mentioned earlier. And in fact, Implats is still coming under quite a lot of pressure. We think that as that platinum price does normalize, as the cycle moves forward, that those still represent quite a bit of upside relative to the fair value of those businesses through the cycle. We've got local bank Standard Bank, and then of course the UK and European retailers Tesco and Sonai, local technology turnaround story, Altron, Japanese energy company Inpex, and overall I think that's a good representation of the wider portfolio as well. So we introduced a few new stocks in the portfolio that included on the local side Life Healthcare Group, which is of course the second largest private hospital operator in South Africa. And then we introduced global stocks Sports Direct, which is the UK sports retailer, and insurance companies Porto Seguro and Unica. So Life Healthcare hasn't really seen a pullback in the price, but what's happened there is that the underlying value of the company has grown ahead of the actual price. So their investors are getting value through excellent cash flow generation on a multiple which is lower than what you'd normally have to pay to get that. Sports Direct is the largest sporting goods retailer in the UK, and it's seen its share price come under quite a bit of pressure as a result of Brexit, which impacted a lot of retailers. And the pound has impacted the gross margin of its imported products, and there are a few other sort of company-specific issues which need to be worked through, but the price represents quite a bit of upside from this point, assuming that happens, and if assuming our investment thesis is correct. Porto Seguro is the third largest insurance company in Brazil, so there you're getting a bit of emerging market exposure. A lot of the opportunities that are popping up globally are in the emerging markets parts of the market. They've got the largest market share in the car insurance part of the market with 30%, and there we look at vehicle sales, which have recently hit decade lows in Brazil. So what you're really sort of doing is buying a business where the market's being very short-sighted, it's not looking through that cycle, and we should see the business trading at levels sort of higher than today relative to book value as that cycle normalizes. Unica is the second largest insurance company in Austria, so they have representation in other parts of Europe as well. Business is undervalued largely as a result of those low interest rates that I mentioned earlier. That's put a lot of pressure on capital earnings and growth prospects for insurance companies in that region. And the difference with Unica is that the dividend yield for that business is 6.7%. And that dividend yield is sustainable as well. So investors are actually being paid to wait for conditions to improve. Timing of that is uncertain, but the interest rate cycle will turn at some point, and you're getting a 6.7% dividend yield in the meanwhile. So to conclude, the RECM Global Flexible Fund is a robust portfolio of local and global value opportunities. Over the last year, we have been able to introduce quite a few new investments into the portfolio, and the value cycle is still very much a tailwind for value investors over the next horizon. And we'll continue to do our best to keep the portfolio as robust as possible and to continue populating it with good companies trading at good prices.